everybody. Welcome to the Fundamental Analysis webinar here with AvaTrade. My name is Troy. I'll be presenting. As we get started, as always, keep in mind that there's risk involved with each trade that you take. So make sure you manage risk in a way that makes sense for yourself with trade sizes that have the exposure amount to wherever you might pick your stop loss, etc., that you're comfortable with. And also keep in mind that what we cover is not meant to be financial advisement, but is coming from an educational perspective. Now, from our main website, we can log into our web trader platform, which allows you to trade on both MT4 and MT5 accounts, but with the advanced functionality that you find in both our app and our web trader. And in terms of the risk management side, it makes things up quite a bit easier because the order window within our app and web trader allow you to understand how much you're risking to your stop loss price based on the lot size that you put, and all of this is calculated for you before you ever place your trade. So it makes things pretty simple in that regard. So if we log in here in the upper right hand corner, we'll find ourselves in the web trader platform. Now on the fundamental side, which is our focus in today's session, we had some big news yesterday out of the US. So they had a rate decision and press conference about monetary policy moving forward. And as expected, the rate decision was 0.25% cut. That was the consensus expectation, and that's exactly what happened. So not a big surprise there. But the focus more was on, well, what will Jerome Powell, who has the final word on rate decisions in the U.S. What would he say during the press conference in his statement, but also during the back and forth questioning from the media as he answered various questions about monetary policy moving forward. And so he took kind of a subdued tone in terms of future rate cuts. He was very careful to back off the idea that they've started on a path of rate cuts that are expected to be multiple rate cuts moving forward. He wouldn't commit to that type of path. He said it was more of a risk management rate cut this time, and that each subsequent decision will be based on the data from now until that next decision, and that you can't anticipate in advance for sure what the data will be in terms of the focus really is on the job creation numbers, unemployment rate, which obviously relates to jobs, and inflationary data. Those are the two main things, inflationary data and jobs. And he pointed out very strongly that depending on how that data comes in, that will help determine whether there'll be more rate cuts, what size will the rate cuts be, etc. And so the markets weren't terribly excited, at least not initially, about that tone. Certainly the stock market and businesses and consumers like the idea of lower interest rates. But the flip side is, nobody likes the idea necessarily of higher prices and more inflation. So it's a balancing act, and that's what Jerome Powell explained in the press conference and with all of the questions that were coming in about the policy moving forward, that they're kind of stuck. And he even readily admitted that they're in a tough spot because the most recent inflationary data was higher than expected out of the US. Not in a huge way, but a tick up more than expected in some of the most recent CPI data and PPI data, the consumer pricing index, the producer pricing index, etc. The most recent data out of the US has shown that it's just not heading lower these past month or two to get to the 2% inflationary target. It's up 3% plus. And so he pointed that out and said they're opposing factors, that the inflation is still higher than they want, so they're afraid to lower interest rates, but the employment numbers are getting really bad for new hiring. Although the unemployment rate hasn't ticked up much, the hiring, the number of new jobs created has really plummeted. And so they want to cut interest rates to help out businesses to be able to expand at a cheaper cost and hire more people, because hiring has really plummeted. But at the same time, inflation has been a little bit sticky and not getting down to the target of 2%. And the point was they're not going to lower or raise their target. Someone suggested in some of the questioning that, well, maybe your target is too low. If to reach 2% inflation, you're going to destroy job creation, perhaps your target should be something more like 2.5% instead of 2% or 2.8%, where it had already gotten down to. And he kind of scoffed at that idea and said, no, the target is 2%. So he seems not to want to negotiate on that side of things. So the market didn't like that situation, that even the person making the decisions is admitting that they're in a tough spot and it's hard to make a decision whether to cut interest rates or not. He actually said that. So there's no direction, no clear direction for the next meeting and the next meeting that there's a path of rate cuts coming or not. And so the market, it's rising a bit today, but I don't think with the cheer and optimism that it would have been rising in terms of the equities and the major indices, had he been a little bit more hawkish about future rate cuts. Now, since there's a hyper focus on jobs and hiring as the reason for the rate cut that they just did, because the balancing act is the job creation is worse now and it's a bigger risk than inflation. So that's why the rate cut was agreed upon yesterday, because they feel they need to fix the job situation more than they need to worry about inflation right now. So the rate cut was enacted even with inflation higher than what they like. So that's the situation right now. So any inflationary data and any jobs data out of the US, there will be a hyper focus and probably an inflated reaction on major US indices and with the strength of the US dollar. So that's the fundamental backdrop. If we look at the US indices right now, if we look at US dollar pairings or even commodities that are paired against the US dollar, we have to keep that in mind, that there was a rate cut. There's not a huge expectation of large rate cuts to come necessarily, but as long as jobs numbers continue to look bad, then the market might actually cheer that bad news, because that increased the expectation of more rate cuts and maybe larger rate cuts. So we just don't happen to have some of that data coming in today. So if we look at the economic calendar, and if we look at today's announcements in the economic calendar, again, that's found in our Market Buzz section, economic calendar, and then just pick the date that you want, pick the level of announcements that you're interested in. I usually pay most attention to the high level announcements. It means they have a larger effect on the currency pairings on the market than the medium or lower level. I do list the medium ones, but I leave off the low importance announcements. Now, out of the European Union, out of the UK, yesterday, we saw lower than expected inflationary data. So the opposite of the US right now. The inflation seems to be more under control in other areas, including the European Union and the UK, than it does in the US right now. So the problem is, with that really low inflation is coming in worse than expected economic numbers. So employment change out of Australia, for example. Yeah, their inflation is down, but look at the job creation. So employment change, the last numbers came in at 26,500 new jobs. They expected 15,000, so they already expected it to drop. And what did it come in? Negative 5,400. They're losing jobs. Okay, this is the problem that's starting in the U.S. And hence the rate cut yesterday, even though inflation is still up. And some are saying if Powell waits for inflation to come down to 2%, the U.S. might need to be in a recession for that to happen. Okay, so not that that's true, but that seems to be the direction they're headed. As inflation gets lower and lower, the jobs numbers are getting destroyed. And so in countries where inflation is even lower, EU, UK, and then look at the jobs numbers out of Australia. Okay, full-time employment went down. Almost 41,000 less people with full-time employment. You say, well, what about the unemployment rate? Why didn't it go up then? Well, because they're counting part-time jobs. So if you're at least working part-time, they don't consider you unemployed. But the problem is you're underemployed, even if you're not unemployed. So full-time employment, it's dropping, not rising. Okay, and so those numbers look bad out of Australia. And so the fact that inflationary data is low in the EU and the UK also, we better look out for jobs numbers then. Perhaps those jobs numbers that come out next in the EU and UK also might not look good. Okay. Now, out of Great Britain, we have a rate decision. Now, the UK and the EU have led the way with rate cuts ahead of the US. So, you know, it looks like they're going to, the expectation is the rate will be kept the same in the UK. Maybe their jobs numbers aren't as bad. We'll see what the next numbers are. But currently they feel it's okay. They don't feel the need to lower the interest rate any further necessarily in Great Britain, according to this expected column. We'll see how it comes in. It's hard to trade on those rate decisions because most of the time they come in at expectation. And so that doesn't garner necessarily a big movement. It's the press conference afterwards that you get more movement when they start talking about what their plans are moving forward, which then you might hear something unexpected and it might shake the market more. And so it's hard to trade off of the rate decision itself. And I can show you the data. If we go to this tool, the volatility index, any pairing you want against the Great Britain pound, you can pick. We'll leave it on GBP USD. If we look and see, well, how many of these has the rate decision been higher than expected? None. How many has it been below forecast? None. So the rate decision almost always comes in as expected. And right now it's expected that there'll be no change. So if it comes in matching the forecast, you can see half the time it goes up, half the time it goes down. The distance going up is similar to the distance going down. So it's very close to 50-50 in terms of pip movement up and down. Some of them barely moved. I know it says 63% went down when it comes in matching forecast, but 4 of these that went down barely moved. Okay, so it's really, I don't see an advantage one way or another to try and trade off of a rate decision that comes in at expectation. Now, if this came in higher than expected, meaning they raised the interest rate, well, then you'd expect the pound to strengthen rapidly. That's the typical result with an unexpected rate increase. Or if it comes in as a rate cut, if they lower the interest rate unexpectedly, you'd probably see a rapid weakening of the pound, and the USD may be pulling it down. So barring an unexpected rate decision, which again, we don't have data on that because in the past year it hasn't happened within this data set. So I tend to skip over these and move on to announcements where the numbers many times aren't exactly the same as the predicted count. So if we go to initial jobless claims out of the US, remember the reason they cut the interest rate yesterday, even though inflation is higher than they want, is because they think the job situation in the US has gotten so bad that it's worth risking inflation going back up to try and help out the job situation. So they cut the interest rate, knowing that that could lead to more inflation, even when they haven't reached their target inflation number yet, because the jobs numbers are that bad. So there's a hyper focus now on jobs numbers. So jobless claims, that's people who are out of work applying for unemployment. Okay, so those numbers expected to tick down from 263,000 to 250. If these numbers come in even lower than that, meaning better than expected, less people applying for jobless claims, that would be a sign of strength in the labor market. And that might increase the expectation that, hey, Powell's not going to lower interest rates any further because he's worried about inflation. And if the jobs numbers are better than expected, then he'd be less likely to lower rates the next decision. And he even said each decision will be data dependent. And this first rate cut, he says, doesn't mean that we've launched into a series of rate cuts. Those are his words, more or less, not the exact quote, but that's basically what his message was. So if we look at this volatility tool and we look at a pairing like USD JPY or Euro USD, I like the JPY pairing because the yen tends to weaken when there's not fear about things, and tends to strengthen when there is fear. And the USD will do the opposite. When there's good news, it will strengthen while the yen is weakening. And when there's bad news, the USD should weaken while the yen strengthens, because the yen being a stronger safe haven currency than the USD typically. So I like this pairing many times. So we'll look at this pairing, and you can go through and look at other pairings with the home country currency for the announcement, in this case the USD, to see which statistics you like the best from the past to trade on. But we'll stick with USD JPY for this example. 4 hours after the event, and if we say when these have come in below forecast, meaning good news, better than expected news, less jobless claims than expected, okay, USD has climbed 75% of the time in the 4 hours after the event. Makes sense, right? Better than expected news, below forecast for jobless claims, USD strengthens. You might have that effect now even magnified more because of what Powell said yesterday. He said the only reason he did the rate cut, even though inflation is higher than expected, is because the jobs numbers have been horrible. So if the jobs numbers come in better than expected, less jobless claims than expected, all of a sudden the idea will be, well, Powell won't lower interest rates anymore because he said he's worried about inflation and doesn't want to lower interest rates. He only did it because of bad jobs numbers. So if these come in better than expected, meaning lower than expected, you might see not only did it go up 75% of the time in the past, you might see that even magnified more. Okay, I'm not saying 100% for sure, but based on what happened yesterday, that logically could make sense. So already the statistics are there to think if these numbers come in below expectation, better news than expected, it looks like buying makes sense. We're talking, look at how much some of these moved. 130 pips on this one, 128 pips on this one, 74 pips. Most of these are nice movements, over 40 pips. Okay, these ones were smaller, but look at the downward movements. Even if you traded on the time that it went the wrong way, they barely moved, 24 pips, and this one was just a couple pips down. So really only one had significant dropping, and it wasn't that much in the 4 hours after the event. The average movement up was larger, and it went up more often. Okay, so I know what I would do if I'm trading this announcement today. If the numbers come in below forecast, in the first 5 minutes, I'm going to see if I can catch movements that have barely gone up. Okay, you see most of these are 7 pips, barely moved. This one, 34 pips. Okay, one you might have missed in the first 5 minutes. The rest of them, based on what happened in the past, it looks like this would be a move that would make sense. And by the way, it doesn't take 5 minutes to place a trade. So not only did these only move around 15 pips in the first 5 minutes, if you have your trade set up ready to go and you're just waiting for those numbers to come in better than expected, and if they did, you could trade within 5 seconds. It doesn't take 5 minutes to place a trade. So even if you took a while, the bulk of the movement didn't occur until after a longer time period, where we see 70, 80, 130 pips movement in the hours that followed, okay, with very little downward movement. Now the question is, well, what if it comes in the other way? What if the announcement is worse than expected, meaning higher jobless claims than expected? Well, wouldn't that increase the anticipation that then Powell will do more rate cuts if the jobless claims are rising faster than expected? That's going to play right into what he said, that he feels like he needs to lower interest rates to save the job situation, even if it's at the expense of causing more inflation right now, because he's more worried about the poor numbers on jobs than he is about the slightly higher than perfect inflation rate. So if this comes in above forecast, you might see a weakening of the USD in anticipation then of more rate cuts. And you see in the past a muted climb in those 4 hours. It's clearly different than when the numbers came in better than expected. You saw everything was almost, all the movement was up. Now you see a big movement down, and the upward movements are muted. Almost very little upward movement. Now, if you switch the time frame, you'll see it even more. In the first hour, it's almost all downward movement. Okay, it's not until after the first hour that it recovers and tries to come back up. But you see the initial surge is sell the USD, 75% downward movement with very little upward movement when these numbers come in better than expected. Or I'm sorry, worse than expected. Okay, above forecast, worse than expected, more jobless claims than expected. USD weakens, yen pulls it down. Okay, the opposite, below forecast, almost all upward movement in the first hour, and also it continues after 4 hours. Okay, so if this comes in worse than expected, meaning higher than expected, I'm probably not trading. It was a muted movement. It was more down than up in the first hour, but it didn't carry on. It just kind of killed the movement when these numbers came in above forecast, worse than expected. But if these come in better than expected, you can see in the past that resulted in a rapid strengthening of the USD over the next hour to 4 hours. So that would be my preferred result. If it comes in below forecast, I'm looking for an entry point to buy based on this data with a limited stop loss, maybe no lower than this largest downward movement. And if it hits that stop loss, then something's different than these past multiple times with this announcement. And then it would make sense to get out. Otherwise, you get your stop loss just below this largest downward movement. Try and get an entry point that's not up too high in the first seconds after the numbers maybe come in below forecast, and see how that plays out. Okay, you're not going to win every time trading with this type of data, but you can see the potential is there. Work on your timing, work on finding the announcements that have the strongest statistics to trade in the direction that you think gives you the most benefit. Okay, and I really like the jobless claims right now because of what was said yesterday in the press conference with Jerome Powell, and there's a huge focus right now on jobs in the US. Okay, and the data set is really strong, 75% either way, depending on how these numbers come in, a little stronger, more sustained movement in the upward direction if those numbers are stronger than or lower than expected, which it would be better than expected for initial jobless claims. Now, you can, at the start of each week, or better yet, over the weekend, Saturday, Sunday, you can go through the next week's announcements on this schedule. You can go to the next week and look at each day and find the announcements that have the best statistics, like I just showed you, and that fit your time frame that you're available, and pick out the best 5 or 6 announcements that you might be available to watch the numbers come in and trade on that past data, on those statistics, and do that for several months, because these announcements are repetitive each week, each month, and then see which announcements am I winning more than I'm losing on. And don't decide the first time you try it if you had a loss. Okay, you're not going to win every time. We saw it went up 75% of the time, for example, on the one. So if I tried it 4 or 5 or 6 times, then hopefully I win 4 out of 6, something like that. And find which ones work the best for you. And then that becomes part of your bag of strategies that you trade with, to diversify your trading strategies. Now, what else can we look at for fundamental analysis? We can go to the market buzz. Within the market buzz, you can pull up any instrument that we offer and see what's the most recent news. You can switch to cryptos, currencies, commodities, and indices, as well as the stocks. Okay, I might want to know, well, what's going on with NVIDIA? That all of a sudden they're trending maybe more than you saw the prior day. You see, the larger the circle, the more they're trending, the more hits we found online with new talk about that particular instrument. So if we pull up NVIDIA, one thing that'll jump out at you is the trend analysis. Okay, if you want to look at the technical side along with the fundamentals, which I recommend you do, it's just more knowledge to make your decision with. The technical side says they think the price might fall over 8%. Okay, we can take a look at that. Here's the technical breakdown. It shows the direction that they expect it to go. The red lines are the take profit zone that they think it might pull down to. And there's an explanation about all the technical levels and the indicators that were used. Okay? That's the technical signal. Now, you need to check the news and see, do I think fundamentally that makes sense? Okay. So China ends Google probe, focuses on NVIDIA in US trade talks. China's been threatening not to buy NVIDIA chips. If you start clicking and reading these articles, you'll start to realize why there might be bearish pressure on NVIDIA. So click the link from the Market Buzz, read the article, and see, well, what's the latest news? This is the most recent article. Okay, maybe China now saying, okay, we'll negotiate. We're not going to just stop buying NVIDIA chips. Maybe. You have to read the article and see. If you go down just a little further, you start to see right here, Huawei to launch AI superpods as China cuts NVIDIA dependence. That's weighing on NVIDIA because China was a big buyer of their chips. And now, because of the tariff situation and the trade talks between the US and China, they're threatening not to buy NVIDIA chips or to try and cut their dependence on NVIDIA. Okay, so that's not good for NVIDIA. Then start reading these articles, that sounds like maybe bad news. Then you start to understand this technical signal. Maybe you agree with the technical signal, that perhaps there's a downtrend that started. Okay, downtrends start for fundamental reasons typically. So the fact that the technical signal sees a downtrend and says it looks like it's going to drop to the next support level, and then the headlines maybe that you find match that type of sentiment, then all of a sudden that signal might make more sense when the US market opens to act on. Okay, and I also saw another article that was not necessarily good news for NVIDIA, down a little bit lower. Let me find it. NVIDIA is one of the most heavily shorted stocks right now for hedge funds. And there's an article down here from not that long ago, about 8 hours back or 10 hours back, which is just barely, not even into yesterday, it's still today, this morning, the article came out that NVIDIA is one of the most heavily shorted stocks out there. Here, more bad news articles. China tells companies to stop buying NVIDIA's repurposed AI chip. Okay, so this has been going on. That was only 11 hours ago. Okay, all right, here's the article. NVIDIA overtakes Apple as most shorted stock. So a bunch of negative headlines here. Shorting means people are selling it. They're hedging themselves on the futures market with short contracts because they think there should be some kind of pullback. And it makes sense when you read these articles that there's a lot of talk about China trying to not buy NVIDIA's chips anymore. Kind of a trade war thing going on here. The most recent article says that they're going to negotiate now. So we'll see how those negotiations go, right? Part of that negotiation might be on the US side to say you still need to buy NVIDIA chips or else they're going to have tariffs, that sort of thing. So we'll see how that works out, but it's creating certainly nervousness, some bearish pressure it sounds like, and we've got a signal saying that NVIDIA might drop over 8%. So based on this fundamental news, when the US market opens, I'm going to check the chart and see, did it gap down at the open? Is it downtrending, say on the 5-minute, 15-minute candles? Where's the closest support level? And I can refer to this signal to see where Trading Central thinks the next major support level is, and you can see it on the chart. This was resistance right here, and then it became support. And so that's where they're saying take profit if you're shorting. Okay, so you can put things together using this tool, the Market Buzz, and that's a whole nother strategy for you to trade with without ever having to leave our platform. And all of this is available in our app as well. So you can have one strategy to trade off that data from the economic calendar like I showed you. You can have a strategy to check out individual stocks or currency pairings or indices with the Market Buzz tool to see what's the most recent news. And that is a second strategy to trade off of. What else can we do? Well, we know the bigger picture news from yesterday. Okay, we know that the U.S. lowered interest rates. We know they're going to be very careful moving forward about lowering it more. We understand the jobs market in the U.S. is really weak right now. And so that might weigh on people to start fearing that, wow, the U.S. is really slowing down. The jobs numbers aren't good. They may or may not lower interest rates any further, which scares people. And so maybe gold is something people run into as a safe haven. Maybe something like crude oil might be seen as something that will have less demand for crude oil. If things are slowing down with jobs, it means things are slowing down with businesses, which means there'll be less energy demand. And so perhaps that's a bearish sentiment for something like crude oil. So you can start to play into this, the bigger picture type macroeconomic effect it could have on things like crude oil, gold, etc. Okay, so if you think all of this can create fear about economic crises, then you might look at gold and say, well, what can I do with gold then? And so yesterday, preemptively, we did a technical strategy with gold to buy on gold before the interest rate decision, with the idea that there might be some fear created around that rate cut and whatever was said in the press conference. Certainly there was some fear created with that. The expectation of maybe future rate cuts paired with the fact that the jobs numbers are not looking good and inflation is still higher than expected, that's a kind of a storm brewing maybe to have people still want to buy into gold. And so we preemptively traded on gold yesterday, more from the technical side. And now from the fundamental side, it feels like that was also a good move after listening to the press conference yesterday. So as we look at the gold chart then, let me just get the order window out of the way. What we see is a big spike up with the news yesterday, a spike back down, a carry to the support level that we drew yesterday down here, and then a bounce back up with gold. So it looks like gold, after spiking around, which was expected, that's why we used AvaProtect with the trades yesterday. AvaProtect allows you not to get stopped out. I even said before, I said you'll probably see gold go up 50 an ounce, go down 50 an ounce. If you have a stop loss on your trade, you'd be knocked out in either direction potentially. So we went with AvaProtect in lieu of a stop loss, and so we're still in the trade now. Those trades are running. I'll show you, maybe show them to you in a minute. Still running a Euro USD trade and a gold trade, both going against the USD with the idea that there's a slowdown in jobs. There's having to cut interest rates now in the USD because of the slowdown. Both of those are bad news somewhat for the strength of the US dollar. And now fears of inflation. Maybe the US dollar is not something that's so attractive now. So high inflation with bad jobs numbers, it's really a death sentence maybe for the strength of the USD. We'll see. But it seems like a currency that maybe there'll be some apprehension about. So here's gold. If we then maybe go to the smaller candles, we can see that bounce. Here's that support level, okay? Support, support, holding above that price multiple times. We got near it yesterday. This is the announcement, the rate decision in the press conference, up and down. Got near this support level, actually held at this next support level right here. Okay, this was a secondary, this was one support level, this was another one here from the past, and it actually bounced off that one. Okay, so it didn't even break this smaller support to test the lower one. So gold running back up now today, and it looks like it might be in a situation, it already broke above this high point, so technically it's uptrending and looks like it might want to challenge that all-time high. We'll see. Certainly I feel the fundamentals are there to create more reason than not, a reason to maybe leave the US dollar right now with all the uncertainty around the US economy and rate decisions, etc., and maybe go into something like gold or other currencies against the US dollar. We see that Great Britain expected not to lower their rate today. Okay, moving forward, everyone says, well, the US doesn't know what they'll do. People don't like indecision. And so if we see The UK is on a track to not lower interest rates, and they're adamant about that right now, that they don't need to lower interest rates. And in the US, Jerome Powell's waffling, kind of saying, well, maybe we do, maybe we don't, we'll see, and basically saying that he's confused about what to do for sure. He kind of flat out came out and said that it's a tough situation to, if he lowers interest rates, inflation goes up. If he keeps the interest rates where they are, the jobs get worse. And he felt like he was forced to lower interest rates when he didn't want to. So that's not a good situation for investors many times to want to invest into. So from a fundamental perspective, it feels like the USD has become maybe a little toxic right now in terms of investors wanting to buy into it. So if that's how you feel fundamentally, from a macroeconomic perspective, not just because of one particular announcement. So this is a third way you can trade, off of the larger view that you feel all of this news creates for a particular asset. And so gold is one of those then that we could look at and say, well, no reason, if there's fear about the US dollar and fear about inflation and fear about bad jobs, no reason gold shouldn't be able to rise towards the all-time high once again that it was at just a couple days ago. Okay, and not to mention there's a slowdown in the European Union, there's a slowdown in the UK, inflationary data coming in lower than expected. At some point you start to realize when inflationary data is lower than expected, that means the economy is not doing well. It means it's slowing down, there's not demand in the economy. So as happy as everyone was when inflation was coming down because it was too high, now that inflation's more under control, you like to see demand in the economy. And if these numbers keep showing lower than expected CPI data, lower than expected PPI data, lower than expected demand in general, that starts to create economic fear, and that's another stimulus to buy into safe havens. So it's not just in the US that could drive gold upward. So from a larger global macroeconomic perspective, if you chose to buy on gold here, then it's a pretty simple setup. You can either use support levels to get your stop loss down below it. So I can go and say, this is the first resistance level here. I see resistance, I see a breakthrough, and then that becomes support here and support here. So this is the first support / resistance level that if this is going to be an uptrend, it might bounce off that. So if you're buying and you want to put a stop loss, you could put it here. If you want your stop a little further, you put it below the next support level here, and even more secure, you put your stop loss below the larger support level down here, depending on what size trade you want to take and how patient you'd want to be with your stop loss. Now, I submit that right now, there's a lot on the table. There's trade negotiations with China going on right now that involves a huge company like NVIDIA. There's a lot there that could swing gold beyond just this talk about US jobs and rate decision. So because of that, I've been utilizing AvaProtect quite a bit because it allows you not to get stopped out of trades without having to risk really long stop losses. So you can take a significant trade size that can give you a nice large potential profit without having to risk a lot on the downside when you use AvaProtect. Okay, so the example is the gold and Euro USD trades that we simulated yesterday and took. The big move up and down that occurred here, this big spike up, this big spike down, we didn't get knocked out of the gold or the Euro USD trade. They're still running. Why? Because we used AvaProtect. I'm protected all the way through till tomorrow, in fact. I can be patient and wait for those to hopefully move into profit. And if not, I only lost the amount I paid for the protection, which was less than 1% of my account in each case. Okay, so we can simulate that same idea and trade based on the fundamentals here, that you might view that there's a lot of reason for gold to climb. There's also an uptrend showing technically where it just broke to a higher high than this little pivot point. So the high points are getting higher and the support levels are getting broke through. So it bounced off this support, it broke through this resistance, and now it's above that. So this is a strong uptrend now today. So you've got technicals on your side for buying here and maybe the fundamentals as well, depending on any new headlines that might come out. So if I'm protecting for a couple days, that takes me through to tomorrow is 1 day, and then from Friday to Monday is 2 business days. So that protects me really for 4 days. It's a deal, 2 days protection. I'm really getting 4 days all the way through the weekend to Monday at 5 p.m. my time. Okay, so now I just need to adjust the trade size to a size that I'm comfortable with in terms of the cost of the protection, which is my risk at this point all the way to Monday. So if I do 0.3 on the trade size, that's less than 1% of my account. Okay, my current equity is about 59, 60,000. No, that's my free margin. My current equity is over 60,000 with 2 trades running. So I'll go with the equity and not the balance. So 60,000. So around 600 is 1%. So that's what this is, approximately 1% cost for the protection. That's my risk all the way until Monday at 5 p.m. Easily 30 ounces of gold could make much more profit than that by Monday. So if my take profit is the all-time high, which would be about 37.05, something like that, I'm looking at over 1,100 possible profit. If I think it'll break the all-time high and go to, say, the next round number, like 37.50, okay, then I'm looking at almost 2,500 profit. So with that type of setup, which is pretty realistic for gold to go 40 or 50 or $60 an ounce up, if we go to, let's say, 4-hour candles, we'll see 37.50 is not that far up. It's here. Okay, so the climb that it did just in the last couple days is more than the climb it would need to get to our take profit. And we have all the way till Monday at 5 p.m. Okay, the time of your expiry will be based on your time zone, by the way. Okay, so risking less than 1% to try and make greater than 4%. Okay, so I'm capping my risk where I'm comfortable. I'm going in the direction that the fundamental news feels like it makes sense to go, and I didn't put a stop loss. Why did I not put a stop loss? Because I have protection all the way to Monday. It could go down as far as it wants, but I can be patient for it to come back up without having to risk losing more. So I don't need a stop loss that might knock me out of the trade. I can add a stop loss later if I wish. And I better double check that there wasn't by default a stop loss price in there. Let me take a look on this trade. If I want to edit, you can take a look and you see stop loss was not ticked. So I've got to take profit, but no stop loss. I can add a stop loss at any time from this location. But for now, I'm protected for another 99 hours and 16 minutes. So I have no worry about needing to protect by stop loss, because any negative in this time frame is added back if I lose when the trade closes. Okay, so any negative movement, I don't have to worry about that during the protected time period. So I've got trades that then can run as a different strategy concept with more patience without a stop loss for a while. So I think this is a good place to stop. We've gone through a few strategy concepts using the tools that are built into the web trader and our app. One was using economic announcements to trade based on the past data as the numbers come in. Another strategy was using the market buzz to find the latest news to trade in a direction that makes sense, maybe paired with signals that are also there. And the third was the trade off of the bigger macroeconomic news, as you understand it. In this case, we're talking about maybe a rush to safe havens if there's fear about interest rates and tariffs and everything that's going on. So maybe you found a reason that something like gold you think might be in demand, as an example. Okay. And again, you're not going to be right on each trade that you make, but in the end, if you start to follow strategies like this, and you find at the end of maybe not each day, but at the end of each week, each month, you're winning more than you're losing, because you're putting the news and the technical side of things together to drive your decision making, then that's what it's about. Gradually winning more than you're losing, and then you're on to something. Okay. All right, thank you everybody for joining. I appreciate the participation, and good luck with your trading the rest of the week. I'll be back at it in the coming weeks with more sessions. All right, everybody, thanks. Bye for now.